So over to you, Urszula. Thank you very much. About half an hour.
Thank you very much, and I hope you can hear me okay over there in the room. So thank you very much for having me. It is a delight to be with you again, and I do promise I will be there in person next time. Today I'm joining you from Sydney, although as many of you would know, most of my practice is in Hong Kong. And stablecoins is a topic that's very close to my heart and to the work that we've been doing. So we helped an outfit, OKX, sort of well known in the crypto industry, with structuring a stablecoin several years ago. And more recently, we've been working with two large Australian banks with their stablecoin issuances. And then besides that, part of our day-to-day job is working with exchanges to unpack the stablecoins that are out there, as well as to work primarily actually with the banking industry and their response to reforms in that arena. The other key angle to this, of course, is what is happening more generally with the modernization of money. So some of the materials that are available to you, to which we contributed, were projects like the BIS Project Dynamo, and that is a great report, has a lot of detail in it, and not only just the sort of legal and regulatory issues, but broader issues relating to stable coins and tokenized deposits. But we've also been working with the BIS as well on Project Enbridge, which is a multi-CBDC project. And I raise that because a lot of the issues that we will discuss today and the structures of stablecoins are also really quite similar and applicable to how we conceptualize CBDCs. Indeed, they interact and can interact potentially more so in the future as well. So it's important to sort of keep that in the back of our minds, and I'll talk about that a little bit more. Now, in this session, what I wanted to do was, rather than give you a table that compared and contrasted every regulation that was going on around in the world, which of course is possible, but to really address this in a deeper way, to firstly talk a little bit about those key functionalities of a stablecoin, the typical issuance and redemption structure, to start off with the wash. Are we regulating? Then to move to the why we are regulating, to think a bit more deeply around the actual risks in relation to stable coins that are perhaps different to other types of crypto assets, and which are driving regulatory change around the world. And then, of course, how regulators globally, in my experience, are tackling the issue, with a particular focus, as you mentioned, Louise, in the Far East and the Asia Pacific and the jurisdictions that are closest to home for me. But luckily, we do have Simon there as well, and I'm especially eager to hear from him, because I'm aware of the impacts of the impending go live of MiCA, and certainly a lot of press around the potential impact on stablecoins. Now, to kick off then, the dominant theme, of course, is that the focus of regulation is on these fiat referenced, centralized and collateralized stablecoins. So while the algorithmic stablecoin world is still in the mix, and that's particularly the case in a number of markets, which I'll come to, the driving force is around making sure that the structure of these centralized, collateralized, fiat reference stablecoins is robust. So let's talk through a typical issuance, because I think it becomes very obvious what the where the risks are. And for those of you who are eminently familiar with this, I do apologize, but I found that even with discussions with my colleagues in banking and finance, it can just be really helpful to sort of talk through some of these. And in a really basic scenario, we'd have a US, let's say a US dollar stablecoin, and I'll have as a customer, a dollar, and I'll send that to the issuer. And in return, I receive a stablecoin, which is minted and sent to me. And generally, I can send that one stablecoin to whomever I like. I can send it to Louise. I could send it to a terrorist, somewhere around the world. With a freely transferable one, I can send it to a friend, and so on. I can put it on an exchange and trade it in that way. So it's tradable freely in that external ecosystem. But if I am assuming I'm still someone that the issuer wants to deal with, if I want to redeem my dollar back, I can. but of course the issuer is not going to want to deal with terrorists, in most cases of the larger stable coins. So it won't be everybody to whom that stable coin may be, issued that can come back and redeem that $1. That's really important from a regulatory standpoint, as well as, in my experience, how banks are thinking about some of the underlying infrastructure. Now, critically, there is in these models no necessary promise of stability. And one of the things that I'm starting to see in regulation that can be very difficult, therefore, to define what a stable coin is. It really is the promise of the redemption of $1 that is critical. It's the trust that the issuer will give me that $1 that's critical to its stability. So, and let me explain that. So in principle, it means that if the open market value is lower than $1, you'll have a segment of the market, the arbitrageurs, who will snap them up and redeem against the issuer at $1, pushing up the price, theoretically. And if its value is higher, then the opposite should happen. So the rebalancing and the maintenance of the peg occurs through that arbitrage of the current prevailing price as well as the faith in the issuer. Now, of course, there are some variations. So we do see in certain stable coins that there is more proactive liquidity provision. There's the engagement of, market makers to make sure there's an ongoing price. There's some other stabilizing mechanisms. And indeed, we might not have that collateralized, centralized structure at all. And that stability can be achieved through the interplay technologically between something else. So Terra Luna was the great example of two assets. One was a stable coin, one was not. But there was a dynamic minting and burning depending on what was going on with the market price. So it had its stability through an algorithmic process rather than in that sort of human, let's say human-based process that we might have with some of the more dominant prevailing stable coins. Now, of course, at the back end, the issuer receives the dollar and needs to do something with it. So it can put it in a bank account or with a custodian. So the USDK was with a US regulated custodian. There's a number of others that will use one or more banks. They can invest it. Go off and invest it into, treasuries, into funds, into other crypto assets, or they could literally do, nothing with it. Though the nothing is harder to do, let's face it. In some cases, they might use it for their own purposes. So this is where the nature of the promises becomes important. So strictly speaking, outside of a regulatory framework, if someone gives me $1, I say that I'll pay them back. I can go and spend that dollar on as part of a purchase on shoes. And it's simply my friend's faith that I will give them $1 back. That is thing. So this whole piece around that $1 is so critical to the faith of stablecoins. Now, in terms of what I get back on redemption, this is also really important. And in the work that we do with the exchanges, unpacking all of these stable coins, you'll be amazed what you see in the terms and conditions of stable coins, and you'll be amazed at how regularly they change. So I recall we did, a review of USDT. This was now several years ago, and several months later, the nature of the rights inherent in USDT had changed. Of course, us lawyers will think, well, was that an effective amendment and so on? But all the same, when we're analysing those rights, those terms are important. Now, in terms of what I can get back on redemption, some will say you get $1 back. We just promised you $1 back. In other cases, they might say it might be $1, but it might be something else. So we can decide whether or not we give you something else. The other thing that differs with these stable coins is the status of the rights that I have. And with the great caveat that some of terms and conditions are really, really rubbish, or say nothing at all, which really, let's face it, makes them rubbish. But, some are a little bit more specific. So with certain of them, they will say specifically the funds are held on behalf of users. And with my lawyer hat on, on behalf of, to me, speaks of a trust or likely trust. So it may be of that nature. In other cases, it's not. It's simply a promise, and we can characterize those promises in lots of different ways. Now, it's obviously, really clear where regulation may play a role. So if I'm relying on a promise, then I'm relying on the credit and the integrity of the issuer. If I'm relying on something more, like an interest in a trust, so I get something more that's recognized at law, then I might have favorable treatment on solvency. But of course, there's no in principle guarantee that the assets are sufficient. So my claim is better, but the assets may not necessarily be sufficient. Now, one thing I'll say about all of these, and this is really relevant to regulation, is that a good lawyer can structure these functions and arrangements in almost any way that's available in our legal toolkit. I can structure that as an interest in a trust, as an interest in a collective investment scheme, as a derivative, as a debenture. And even we've had a situation where we've been asked to draft it as effectively nothing, something that is issued with no promises, and then with a discretionary balancing discretionary redemption. So there are so many different pathways and legal, so let's say, tools at our disposal to structure these in lots of different ways. And so the inherent challenge in regulation is always thinking about the perimeter of any new regulation and how that is actually then reflected in law and adopts that same activity, same risk, same regulation principle. One other thing I'll say is that there's a lot of talk about tokenized deposits, and they're often considered as a subset of stablecoins. So there's a question of whether or not a stablecoin can be a deposit. And this is where we get into some really hairy territory that lawyers love, but and which I think are worth discussing. And in essence, a deposit is, many of you will be aware, is a loan of money, generally repayable on demand. But in many jurisdictions, in most that I've encountered, and it might be different in other markets, is that there isn't a precise delineation of a deposit as compared to a loan of another nature. And so we have to draw from far more deep, from deeper principles relating to the relationship between a depositor and its bank, and the particular duties that are implied, particularly common law, such as the quid care duty, to establish whether or not we've really got a genuine deposit in play versus some other promise or arrangement. And why that's really relevant is because a lot of the stablecoin regulation either excludes tokenized deposits or provides a privileged position for banks. But just to cut to the chase, what we're definitely finding with our bank clients is that doing a tokenized deposit really can only work where it's going to operate in that walled garden of the bank's ecosystem, because it's very difficult to have that relationship move dynamically to persons unknown. So then why do we want to regulate? Of course, first of all, they're important. That's the starting point. It's important to give them a framework to give certainty, and stablecoins have a particularly important role in the digital economy, facilitating atomic transactions. They're programmable. They can provide convenient, swift trade out of position. They also address banking problems. So you'll see a number of exchanges and ecosystem participants who simply don't have access to banking. And I suspect to Australia even, and I know other markets restrict users' interaction with and sending funds to and from exchanges, so that can pose a difficulty. So they've got both pluses, but they also address a need. They're also really popular. So the latest report is a great report by Visa. It's approximately 27.5 million users. And USDT, for example, has a market cap now of 112 billion US dollars. USDC, fair bit behind, but still high at 32 billion. And so it's a significant portion of the market. And of course, popularity is code for systemic risk. Now, interestingly, I just raised for your awareness is that same Visa report I mentioned in just May of this year said that 90% of transactions that it and Aluminum Labs had analysed were by bots or algorithmic processes. Now, that doesn't mean they're like our spam farms of just bots doing nothing for no purpose or terrible purposes, but it speaks to the fact that this isn't just human directed, but that they can play an important role in algorithmic trading and other algorithmic function. Now, of course, money must innovate despite this risk. So while you can have these exquisite old cash registers like the one behind me as lovely keepsakes, they're of course no match for what modernized money can offer, and CBDCs are still fairly behind. Now, the key risks that we're trying to address here are several. So, we had the BIS and IOSCO and other transnational regulators bringing together a number of these risks relating to things like legal certainty, sound governance, money laundering, terrorist financing, other forms of illicit finance, safety, efficiency, integrity, cybersecurity, market integrity, data privacy, consumer investor protection, and tax compliance. Now, putting a practical lens to that, what have we seen? Well, we've seen a number of them, and Moody's in October of last year has a wonderful report around analysing stablecoin instability, and there's another one, ChainSec has a comprehensive list of failed stablecoins, and there are lots of them. But some of the most prominent sort of issues that we've seen are things like the allegations in relation to reserve asset protection at Tether. It's almost a sport on Twitter or X, ruminating about what's going on with Tether reserves. With Terra Luna, it was a collapse of a significant algorithmic stablecoin that led to losses of about $40 billion, and that was related to the rattle and the depeg of that algorithmic involving that algorithmic process, as well as an alleged exploit when that was vulnerable, with some changes that were occurring in relation to underlying reserve management. Now, interestingly, the one that I speak to a lot is the rattle that occurred with USDC last year. So USDC, again, one of the most prominent stable coins, and it temporarily lost its peg, like quite significantly. Usually you see a few, maybe like a cent, and that's still pretty significant for it to rise and fall, one way or another over the $1. But USDC went quite significantly beyond that. Now, the reason for that is because it emerged that the reserve assets were being held at Silicon Valley Bank. And so you had a lot of these eligible holders rushing to redeem their $1. And indeed, for a couple of days there, between Friday and Sunday, there was a real concern as to whether or not those reserves would be accessible. It regained the peg once the US federal authority said that they would effectively guarantee that those deposits would be returned. So in essence, that wasn't so much a USDC, it wasn't a Circle issue, it was a fundamental banking issue. And one of the concerns, of course, is that when you have such a thin market for banking for this sector, you have, of course, these risks relating to concentration and these vulnerabilities. Of course, at a macro level, we've got monetary policy, financial stability, fair competition, and so on. And those risks are important to address. Now, before I move on to the actual, examples of regulation that we have emerging, I wanted to make a few comments. And the first is that in certain cases, a lot of these technological components exacerbate risk or produce new risks. But in certain cases, those technical functions can actually help stem illicit activity. So a really good example there is, many of you might be aware that there was a mixer called Tornado Cash, and it appeared that Tornado Cash was being used to mask transactions and facilitate transactions that supported sanctions and breaches and terrorist financing. I believe it was North Korea was quite an avid user of it, and so OFAC had designated effectively the use of Tornado Cash, as an activity that was prescribed. Sensitive point in the US, I know, because code is speech, but very carefully worded designation there by OFAC. Now, what happened there is that USDC was Circle was quite proactive. So it froze over 75,000 worth of USDC that was linked to 44 Tornado Cash addresses that were sanctioned by OFAC, and was able to pretty swiftly interact with that sanction on a very practical level and effectively impact persons unknown. So of course the addresses were known, but beyond that, not much. And in my personal experience, when we've been working with tracing assets, so after large scale frauds, it really is quite astonishing what you can achieve through on-chain analytics that you just simply couldn't do with bank-to-bank transactions. I know those of you in the room will be very, very aware of that. The second thing I wanted to mention is in the work that we're doing with financial institutions, they're having to grapple with not so much a new regulation around, what they might need to, the conduct obligations they might need to meet, but actually the elasticity of current rules, particularly around financial crime. So the key issue is that if I, as a large bank, set up, a lovely stablecoin, great piece of infrastructure, and have all of these lovely intervention rights or capabilities that I just mentioned in that USDC example, I also see a lot, and I assume a lot of implied responsibility in relation to what I see and the tools that I have at my disposal. So some of the things that keep those banks awake at night is what they need to do if I have an asset that I'm issuing to someone who I know, who I trust, who I've onboarded, and only redeeming from those persons, but I see that wider distribution. And that's what makes it quite different conceptually, even to where banks are involved in direct issuance of cash, as they are in Hong Kong. 3 banks issue cash, but of course they don't see and potentially don't care about the fact that their branded note is used, adverse to their interest. So that's really important. And then secondly, those issues around concentration risk is a stubborn one, but we are seeing some movement now with greater degree of banking services being offered in markets that have highly regulated systems for exchanges and other market participants. And great case in point is Hong Kong. Now let's talk then about the how, the specific areas of regulation that we're seeing, and some of the areas that perhaps are of less focus just yet. I'll leave aside tax. I know that's its whole world. I really focus on financial services regulation. And there's typically sort of 5 key aspects of regulation in my experience. It's trading, so the intermediaries that are involved in trading and other classic intermediary roles like custody. But probably most importantly for this sector and what distinguishes it from other types of assets is the asset itself, its issuance, its structure, its custodial model, its reserve asset management. The third area is nomenclature, so how I can and when I can say that something is stable. So we loosely use the word stablecoin, but of course stablecoin implies stability. So rules around naming, as well as in some cases requiring things to be labeled in a certain way. Some areas of regulation will also focus on use. So, and what I mean by that is that the accessibility by certain persons or for certain purposes. And I see largely the focus on by certain purposes rather than, certain persons rather than purposes. But to give you an example, talk about this in more detail later, in Hong Kong, it's generally exchanges can really only sell or make available services for professional investors in relation to stablecoins. And then finally is looking at the general penetration in the market, the monitoring and limitations. And I understand that that is one of the more EU focused rules rather than what we see necessarily elsewhere. So if we look at some of the case studies, and I promise I'll keep this very focused and to the key points, and probably the easiest one I can mention, of course, is mainland China. And they're simply not permitted. Very easy. Now, I spoke to our Shanghai team just the other day to check that this was still the case, and yes, it's still the case. That falls under the general prohibitions that were issued quite some time ago under a joint announcement from multiple regulators, and there's really no foreseeable change to that, even for tokenized instruments like deposits from financial institutions. The CNY, the eCNY, very much are the key focus, as well as sort of general payments in mainland China. Very simple situation. Now in Hong Kong, we have a far more sophisticated regime under proposal, and you might say that a lot of this looks and feels like, as it does in many jurisdictions, like stored value facilities regime. And in Hong Kong, the question you first ask is it a fiat referenced stablecoin? And it needs to be a representation in a digital format using cryptography. Now, interestingly, one of the tests for this is that it purports to maintain a stable value relative to one or more fiat currencies. And you probably recall when I mentioned earlier that many of these don't purport to necessarily do anything themselves. It's simply through those market forces. So that is a point that was certainly a point of feedback on the consultation. So starting point, is it a fiat referenced stablecoin? And if yes, then does that person issue it in Hong Kong? Does it reference the Hong Kong dollar, or is it actively marketed into to the public of Hong Kong? 3 jurisdictional nexus triggers. The most interesting one of that, it's fine, most regulation is in or marketed to, but the point around referencing the Hong Kong dollar is quite novel for the Hong Kong market, but we certainly see it in more than one jurisdiction. It excludes, this whole realm excludes financial products and instruments that are already covered by existing regimes. So again, we've talked about this. This really poses a significant tension because there are stablecoins that are already regulated, and that becomes a point of making sure that rules are harmonized. Now, the next step after I've satisfied the core criteria, the jurisdictional nexus, is the need to obtain a license. And then I need to make sure that I'm meeting all of the obligations. So there are specific licensing conditions around the issuer, its financial resources, and so on, and reserve assets. There's localization requirements. There's financial capital that's required, and all the reserve assets have to effectively be on a one-to-one basis. Probably the one that the condition that is the most, let's say, surprising because it's slightly kind of hidden as a condition, is that it cannot be an algorithmic stablecoin. And what that means is that it's one thing for a regulation to focus on a particular area and regulate it. This is really one of the very first times that we see a regulation that effectively bans an entire category of product, because an algorithmic stablecoin will meet all the can meet all the tests I've described, but it will fail the conditions of the license. So that is really important. The next bit there is then what happens on sales. We talked about issuance. Then on sale, it must be sold through licensed exchanges, licensed brokers, generally to professionals only, and so on. The next one I mentioned is Australia. So in Australia, the key theme there is that it's part of the payments reforms. So it's very similar to the Singapore regime. It's part of the payment reforms generally, and the issuance of payment stablecoins will be deemed as a payment function, and you'll need a license to do that. Now, the test similarly captures those that are capable of being redeemed for Australian dollars or some other currency, but only where there is active marketing or selling in Australia. So we have a really similar approach that's emerging, as I just mentioned, for Hong Kong. You'll also have under the regulation of intermediaries. So very, very similar structure. In Singapore, and I should say again, one-to-one, it's treated as client money. It needs to be held, effectively, client money needs to be held on trust. In Singapore, you have a number of rules. We've already got 3, I understand, that have been approved by the Singapore authorities, and there's all the similar things: 100% reserve backing, cash equivalent, short-term sovereign debt securities. So really similar to what we've seen in other ones. You've got a really liquid reserve base. And you also have, though that's something a little bit different, is that you have firstly the ability for banks in Singapore to have no additional reserve backing if it's issued as a form of sort of bank liability that's subject to the existing capital rules. So that's quite an important flex point. And then also they need to label the stablecoin an MAS regulated stablecoin to distinguish them from unregulated ones. So that's a really interesting, that goes to the point of naming conventions. The last one I'll mention before handing to Simon is Japan. And the reason I draw out Japan is that it perhaps has a little bit more of a nuanced approach to stablecoins, recognizing there are several different types of them, and therefore should be regulated in different names. And also one of the key distinctions is that banks can also issue and hold the reserve assets as deposits. Now, what I wanted to mention about this is that when we were supporting the banking industry in consultation responses to the Hong Kong regime, I was quite interested that a lot of the banks were not in favor of one-to-one reserve backing, even by otherwise unregulated non-bank issuers. And the concern there was that if someone has access to a form of funds that is held one-to-one, that puts them in a better position than with their deposits in a bank. Because bank deposits are not held on trust, but they're only subject to the sort of capital requirements, which should make them robust, and then the depositor protection regime. So you can absolutely have a shortfall in that when things are set aside. So the concern was that that would give a significant competitive advantage to stablecoins over those traditional payment forms. So to just wrap, I'll just say that some of the key themes that we're starting to see in terms of those points of distinction that some jurisdictions are making, either to address risk or perhaps to differentiate themselves from a competitive standpoint, jurisdictional nexus, whether banks can have a privileged position on the reserves, who is eligible to offer and to buy, the specifics on the conduct requirements. And then the final one, which is perhaps most important for our global stablecoin issuers, is the reality that some of these structural points will be very difficult to satisfy for each jurisdiction without some sort of equivalency regime. It's the same issue that we're seeing with a lot of our exchange clients in trying to launch global order books. When you're regulating something structurally, it's very difficult to marry all the rules. And that's why we have principles of home banking supervision, generally having deference to our home regulator. And we just haven't seen that emerge just yet in the markets that I cover. So thank you. I think I'm just over time, but I certainly welcome questions and otherwise hand the microphone to Simon.